Silver just completed the most volatile month in precious metals history. February opened at $84 per ounce, surged to an unprecedented $150 peak, then collapsed 41% to $92 in the final week's dramatic reversal. Before you consider any silver purchases in March, you need to understand the critical market dynamics that created February day's explosive volatility and what they signal for the weeks ahead. February's silver rally was not driven by typical supply shortage narratives or gradual industrial demand growth. It was the result of converging forces that created perfect storm conditions: institutional portfolio rebalancing, algorithmic momentum trading, and policy uncertainty that amplified every price movement through unprecedented leverage and derivative activity across global exchanges. The month began with massive institutional buying that appeared coordinated across COMEX, London, and Shanghai exchanges. Whether planned coordination or simultaneous institutional recognition of opportunity, the buying pressure represented approximately 340 million ounces of silver equivalent through futures, options, and ETF purchases within the first week of February. Major financial institutions had been building significant long positions throughout January while simultaneously maintaining derivative strategies that would profit from both upward and downward price movements. The institutional positioning created conditions where silver could experience extreme volatility in both directions, depending on which positions were prioritized for profit-taking or risk management. President Trump's February 15th announcement regarding strategic metal policy considerations provided fundamental catalyst that justified institutional silver accumulation, while creating narrative framework for retail investor enthusiasm. The policy discussion around American strategic material security resonated with investors seeking alternatives to traditional financial assets during periods of monetary uncertainty. But February's dramatic conclusion revealed something crucial about modern precious metals markets. The combination of algorithmic trading institutional leverage and retail sentiment can create price movements that become disconnected from underlying physical market conditions until mathematical reversion forces prices back towards sustainable levels. February's silver volatility represented the culmination of structural changes in precious metals markets that had been developing over 18 months through increased institutional participation, algorithmic trading adoption, and growing retail interest in alternative assets during periods of traditional market uncertainty. The setup phase began in late 2025 when institutional investment in commodities accelerated due to portfolio diversification strategies and inflation hedging requirements. Silver attracted particular attention because of its dual characteristics as both industrial commodity and monetary metal, creating investment demand that complemented ongoing industrial consumption growth. Algorithmic trading systems had become dominant force in silver markets, executing millions of orders based on technical patterns, momentum signals, and cross-market correlations that could amplify price movements far beyond what fundamental supply-demand conditions might justify. The algorithms created feedback loops where initial price movements triggered additional buying or selling that accelerated trends beyond human trader expectations. Trump administration policy discussions around strategic material security provided legitimate fundamental backdrop for silver investment interest. The administration's focus on supply chain independence and strategic resource accumulation created investor perception that silver could benefit from government policy support while providing portfolio protection during uncertain economic conditions. Chinese silver market activity contributed additional complexity as Shanghai gold exchange premiums and industrial demand reports influenced global pricing dynamics. Chinese market conditions were often interpreted through incomplete information that created perception of supply stress or demand acceleration that may not have reflected actual physical market conditions. Regional silver trading activity in India and Southeast Asia experienced significant volatility as local traders faced margin pressures and liquidity constraints during periods of rapid price movement. These regional market disruptions created additional supply chain complications that affected global silver availability perceptions. Technical analysis patterns that developed during February's rally attracted momentum-following algorithmic systems and retail traders who interpreted chart formations as continuation signals. However, the technical patterns may have reflected institutional distribution activity rather than accumulation, creating misleading signals for traders relying on traditional technical analysis approaches. Financial media coverage of silver market developments amplified both bullish and bearish narratives without always providing sufficient context about the complexity of institutional trading strategies and algorithmic market participation that dominated actual price discovery mechanisms. Retail investment impact. February's silver volatility created significant challenges for individual investors who purchased silver during the rally phase and experienced substantial portfolio losses during the subsequent decline. Retail investors who entered positions above 120 per ounce faced immediate mark-to-market losses exceeding 25% while learning difficult lessons about precious metals market volatility. Online investment communities documented widespread investor experiences with silver price volatility that exceeded expectations based on historical precious metals performance. Social media platforms reflected both enthusiasm during rally phases and disappointment during decline periods as individual investors struggled to understand the institutional dynamics driving price movements. Margin trading accounts experienced significant stress as silver's rapid decline triggered position closures that amplified losses for leveraged investors. Brokerage firms reported increased margin call activity and account liquidations as retail investors discovered that precious metals could experience equity-like volatility during periods of institutional repositioning. Educational aspects of February's volatility provided valuable lessons about position sizing, risk management, and the importance of understanding institutional market dynamics when investing in commodity markets that have become increasingly influenced by algorithmic trading and sophisticated institutional strategies. Physical market dynamics. Despite paper silver's collapse to $92 per ounce, physical silver dealers maintained substantially higher prices that reflected actual supply and demand conditions in retail precious metals markets. Dealer premiums widened to $25–30 over spot prices as physical market participants recognized disconnection between derivative pricing and actual metal availability. Coin and bullion dealers experienced unprecedented demand from investors seeking to purchase physical silver at declined paper prices. But actual transaction prices remained elevated due to limited inventory and ongoing production constraints at government mints and private refineries. Industrial silver users continued facing procurement challenges despite apparent price improvement in financial markets. Manufacturing companies discovered that actual silver acquisition costs remained elevated, while delivery timelines extended due to physical market conditions that derivative price movements could not immediately address. The London Bullion Market Association and other physical silver markets experienced continued delivery stress as increased interest in physical conversion tested the infrastructure designed for financial settlement rather than large-scale physical distribution. Institutional portfolio effects. Major financial institutions that participated in February's silver market activity generated significant profits through sophisticated trading strategies that captured both upward and downward price movements. Institutional success highlighted the advantages of professional risk management and algorithmic execution capabilities in volatile commodity markets. Commodity-focused investment funds experienced mixed results depending on their positioning and risk management approaches during February's volatility. Some funds benefited from trend-following strategies, while others faced losses from momentum reversals that exceeded stop-loss parameters. Insurance companies and pension funds with precious metals allocations faced quarterly performance pressure from silver volatility that required explanation to beneficiaries and stakeholders who had expected metals to provide portfolio stability rather than additional volatility. Hedge fund strategies that incorporated precious metals exposure had to adapt to volatility levels that exceeded historical parameters used for risk modeling and position sizing calculations. International market implications. European and Asian precious metals markets experienced volatility transmission from American silver trading that demonstrated the interconnectedness of global commodity markets through arbitrage trading and cross-border capital flows. Currency market effects from silver volatility reflected broader investor uncertainty about monetary policy and strategic material policies that could affect international trade relationships and exchange rate stability. Central banks in silver-producing countries faced revenue volatility from mining operations and export taxes that created fiscal planning challenges during periods of extreme precious metals price movements. International commodity exchanges implemented enhanced volatility management procedures to address trading disruptions that could affect market integrity and investor confidence during periods of extreme price movement. The moment that changed everything occurred February 28th, when comprehensive analysis by international market research firms revealed the extent to which modern precious metals markets had evolved beyond traditional supply-demand fundamentals to become complex financial instruments subject to institutional trading strategies and algorithmic execution that could create extended periods of price volatility. The analysis documented how silver markets had attracted institutional participation levels comparable to traditional financial assets, bringing sophisticated trading strategies and risk management approaches that created new dynamics for price discovery and volatility patterns. The institutional presence meant that silver price movements would increasingly reflect portfolio management decisions rather than just physical market conditions. Market structure evolution had reached a point where understanding institutional behavior and algorithmic trading systems became essential for successful precious metals investment rather than traditional approaches that focused primarily on mining production and industrial demand fundamentals. Regulatory authorities recognized that precious metals markets required updated oversight frameworks that addressed algorithmic trading and institutional participation rather than regulations, designed for simpler market structures, dominated by commercial hedging and individual investment. The transformation established precedent for increased precious metals market complexity that would require more sophisticated analysis and risk management approaches from all market participants, from individual investors to institutional portfolio managers. Technology integration in precious metals trading had reached levels that made traditional market analysis insufficient for understanding price movements without incorporating algorithmic trading patterns and institutional positioning strategies. 3 months after February's silver volatility, precious metals markets continue operating under the influence of institutional trading strategies and algorithmic execution that have permanently altered the relationship between fundamental analysis and price discovery mechanisms. Silver investment requires understanding of financial market dynamics rather than just commodity market fundamentals. The transformation has revealed that modern silver markets function as hybrid commodity financial instruments, where institutional portfolio management decisions and algorithmic trading systems can create price movements that may temporarily disconnect from underlying physical market conditions before mathematical reversion occurs. Retail silver investment strategies have evolved to incorporate volatility management and institutional behavior analysis rather than relying primarily on supply-demand fundamentals that may not adequately explain short-term price movements in markets influenced by sophisticated trading algorithms and professional risk management systems. Physical silver markets continue providing alternative price discovery mechanisms that reflect actual supply and demand conditions, but retail investors must understand the relationship between paper and physical pricing during periods of market stress or institutional repositioning. Educational resources for silver investment have expanded to address market structure evolution and the importance of understanding institutional dynamics, algorithmic trading, and volatility management in addition to traditional precious metals. Investment principles. The February volatility established a template for how modern precious metals markets can experience extended periods of price movement driven by institutional trading strategies rather than fundamental factors, requiring more sophisticated analysis and risk management approaches from individual investors. Silver market analysis must now incorporate financial market dynamics, institutional positioning, and algorithmic trading patterns, in addition to traditional commodity factors, including mining production, industrial demand, and monetary policy considerations. March. Silver investment decisions require understanding of the lessons from February's volatility, the importance of position sizing volatility management, and recognition that modern precious metals markets have evolved to include institutional dynamics that can create temporary disconnection between prices and underlying physical market conditions. The evolution is permanent rather than cyclical, meaning that successful silver investment requires adaptation to market structure changes that have brought financial market complexity to commodity markets that traditionally operated through simpler supply-demand mechanisms. Future precious metals. Market analysis must balance traditional commodity fundamentals with understanding of institutional behavior and market structure evolution that can create volatility patterns, requiring more sophisticated risk management approaches than historical precious metals. Investment strategies provided.